The markets don't go straight up or straight down. They move in cycles of strong periods and weak periods. And we call these periods bull markets and bear markets. A good way to remember the terms is to think of how each animal attacks. Bulls attack with their horns, pulling their heads up, and bears attack with their claws, ripping their arms down. If a stock price is rising or expected to go up with a solid uptrend, then we call it bullish. If the major stock indexes such as the S&P 500 or the Dow Jones is on a solid uptrend with rising prices breaking new record highs, we call it a bull market. If stock prices are falling or expected to go down, we call it bearish. If the major stock indexes are falling in price, we call it a bear market. Typically, if the overall market, which is gauged by the major indexes such as the S&P 500, the Nasdaq, and the Dow Jones, if they are down more than 20% from its all-time highs, it's considered to be a bear market. So we are periodically shifting from bull market to bear market. It's part of how the market cycles. It gets hot periods, then it gets cold periods. And on average, over the last 100 years, we typically see bull markets last 6 to 8 years, and then we get a bear market that lasts 1 to 2 years. Then we get a bull market that lasts 6 to 8 years, and then we get a bear market that lasts 1 to 2 years, and so on. Now, these time periods are not an exact science. No one knows how long a bull or bear market will last or when the shift will occur. It's impossible to predict. All we can do is look at the data from what has happened in the past and manage our portfolios accordingly. If your goal is to hold long term, let's say that you're 30 years old and you don't plan on touching your money for the next 30 years, then you just let the market do its thing and don't touch it. But if you're maybe 50 or 60 years old and you may be needing your money very soon for retirement, you need to be a little bit more careful when things get ugly. Now, to help you with this, a financial advisor can design a portfolio that's fit around your age, your risk tolerance, and your personal needs. Now, what traders do is try to time these markets. And this is why trading is very lucrative, because you can make money no matter what the overall market is doing. Because traders are only buying and holding stocks for just a few minutes or a few days, trading is not susceptible to outside influences that make the overall market decline, such as the economy, politics, interest rates, world events, foreign trade, or whatever. No matter if the market is tanking or going sideways, traders have opportunity to profit, because there will always be a company releasing good news that will draw the interest of other traders and investors that push the stock price up, even if it's just for a little bit. The news can be a good earnings report, a positive drug study, or a company merger, anything that creates optimism. And there will always be companies making headlines no matter what direction the overall market or the economy is in. Now, what's really cool is that you can make money if stocks are going up or they're going down. When we buy stocks with the anticipation of the price going up, this is what we call going long, or taking a long position. The concept is buy low and sell high, and this is the most common way to make money in the stock market. But it's commonly unknown that you can make money when stock prices go down, and this is what we call shorting. Shorting is where you borrow shares to sell first with the anticipation the price will go down, and then you buy back the shares at a lower price and then return them. Now, I'm going to save the details of how shorting works for another lesson, but in a nutshell, shorting is the exact opposite of taking a long position. When taking a long position, you hit the buy button to enter into the position, and then you hit the sell button to exit the position. But shorting is the opposite. Shorting requires you to hit the sell button first to enter the position, and then you hit the buy button to exit the position. Now, if the concept of shorting confuses you, don't worry. For the remainder of the course, we would only be discussing strategies taking long positions. So I hope you all learned something. Thank you so much for watching.